Welcome to The Explainer. Today, we're gonna demystify a term you hear in the news all the time, the balance of payments. Now, it sounds super complex, but really, it's just the story of how an entire country manages its money on the world stage. Let's dive right in. So think about this for a second. Every single day, you've got trillions of dollars, euros, and yen just zipping across the globe. Countries are constantly buying, selling, investing, borrowing. So how on earth does a country, any country, keep tabs on all of that activity?
Well, the answer is a tool called the Balance of Payments, or BOP for short. And honestly, the best way to think about it is like a country's gigantic master bank statement with the rest of the world. It tracks every single transaction, giving us this incredibly important snapshot of a nation's financial health.
All right, so let's dig into this a little deeper. What exactly is this global bank statement?
Okay, so here's the textbook definition. The BOPOP is a systematic record of all economic transactions between the residents of a country, and that means everyone. You, me, huge corporations, the government, the whole shebang, and everybody else in the rest of the world. It's the master ledger, usually tallied up quarterly or annually, for a country's entire global financial life.
Now, to make things a little easier, this massive bank statement is split into two main buckets, and to really get it, it helps to just think about your own personal finances.
On one side, you have the current account. This is kind of like your monthly paycheck and all your daily spending. Then, you have the capital account. This is more like your savings, your investments, and any big loans you take out, the long-term financial stuff. Let's start with the current account first.
The current account is all about the here and now, the day-to-day. It tracks the money coming in from exports, when a country sells its cars or software overseas. And it compares that to the money going out for imports, like buying foreign oil or electronics. It also includes stuff like transfers, which is money that, say, a worker abroad sends home to their family. At the end of the day, if you earn more than you spend, that's a surplus. If you spend more than you earn, you get that thing we're always hearing about, a trade deficit.
Now, the capital account is a whole different ballgame. It's not about goods and services, it's about owning assets. So when a foreign company decides to build a factory in your country, that's money coming in, a capital inflow. But when one of your country's own pension funds buys, say, Japanese government bonds, that's money going out, a capital outflow. This is also where big international loans get tracked. This is the investment side of the ledger.
Okay, so you have one account for spending and one for investing. Now here is the single most important rule of the entire system, the golden rule. These two accounts always have to balance each other out. Let's walk through how that works.
So let's play this out. Imagine a country has a current account deficit. That just means it spent more on foreign stuff than it earned selling its own stuff. It's just like you spending more than your paycheck. Where does that extra money come from? It's got to come from somewhere, right? You either dip into your savings or you borrow it. It's the exact same for a country. That deficit has to be paid for with a surplus on the capital account, either by selling assets to foreigners or borrowing from them.
And look, this isn't just a nice theory. It's a fundamental law of accounting. It's called double entry bookkeeping. Every international transaction gets recorded twice, once as a credit, once as a debit. So a deficit in one account has to be matched by a surplus in the other. It's just how the math works. The final complete statement always balances to zero. It has to.
All right, so it's an accounting rule. It always balances. So what? Who cares? Why do economists and governments and investors obsess over these numbers if it all just nets out to zero anyway?
Well, we care because the BOP is like one of the most important economic health reports a country can get. It tells you if a country is essentially living within its means. A big ongoing deficit might be a red flag that its currency is overvalued and could fall. And of course, governments look at this data to make huge decisions on taxes and trade policy. It's truly a window into how a country does business with the entire planet.
And this gets us to the million-dollar question. We hear the term trade deficit thrown around all the time, usually as if it's this terrible sign of economic weakness. But is it really always a bad thing?
The answer is it absolutely depends on why the country is running a deficit. Think of it like this. Is taking out a loan a bad thing? Well, if you're taking a loan to build a factory that's going to create jobs and generate profits for decades, that's a pretty smart move. That's a healthy deficit. But if you're just racking up credit card debt to go on lavish vacations, that's an alarming deficit. It's the same for countries. A deficit that's attracting foreign investment to build for the future can actually be a great sign of a healthy, growing economy. To see exactly how this plays out in the real world, let's look at a super fascinating recent example from India. So for almost 2 decades, India had pretty consistently run a current account deficit, which is totally normal for a fast-growing, emerging economy. It was just part of their growth story. But then in 2020, right in the middle of the pandemic, something wild happened. That deficit didn't just shrink, it flipped into a huge surplus. So why?
The main reason was the global lockdown. International trade pretty much seized up. But for India, its imports, things like oil and gold, they just fell off a cliff, even more than its exports did. Just look at this chart. The trade deficit went from almost $50 billion down to less than $10 billion in a single year. That incredible drop was the #1 driver of the whole shift.
And what was the result of that smaller trade gap? A jaw-dropping current account surplus of almost $35 billion US. And that was just in the first 6 months of their fiscal year.
But wait, that's only half the story. At the exact same time the current account was flipping into a surplus, the capital account was seeing a massive surge of investment. Money was just pouring into the country, especially, as this chart shows, into its red-hot tech sector.
And this is where the India story gets so interesting. The country had a surplus on its current account and a surplus on its capital account, thanks to all those investments. Now hold on a second. Didn't I just say that one is supposed to offset the other? What happens when both are positive? Well, you get what's called an overall balance of payment surplus. It means far more foreign currency was coming into India than was going out. And all that extra money? It was absorbed by India's central bank, which massively boosted their foreign currency reserves and made their whole financial system stronger.
So here's the bottom line. The next time you hear a news report about a scary-sounding trade deficit, you'll know there is so much more to the story. You'll know that by definition, that spending is being financed by investment from the rest of the world. So the real question isn't if a country is borrowing, but what is it borrowing for? Is it funding today's lifestyle, or is it building the factories and technology for tomorrow's growth? That's the question that really matters. Thanks for joining us on The Explainer.